All right, what is up, everybody? Welcome to the Friday Mastermind. I'm always super excited about this, but we've got the chief economist from the NBA, Mike Fratantoni, on today. He's going to give us his thoughts on what's happening in the market. We are literally days away from halftime in 2025. Kristen Messerly and I, for several weeks, have been working on a halftime report. It hit LinkedIn yesterday. We'll put a link to that. But here's the thing, guys. Games, whether it's a sports game, whether it's a business game, you win the game in the second half. And so what I want to do is just like assess what's happened so far that matters, and what adjustments need to be made, and what do we need to do to win the year in the second half of the year. Todd, anything you want to say before we bring on our special guest? And I actually have two special guests, but I'll bring on Ron in a minute. Anything you want to say, brother?
Well, just like you, I love halftime, right? As a guy who lives by a quarterly strategic plan, anytime that you get to sit back and not just look forward of what am I going to make sure that I have, on my calendar that I'm really focused on for the second half of the year, it's really important to look back at the first half of the year and see what we've learned. So I dug into the halftime report that you and Kristen did. It is excellent. And I think that we're really set up for success here, having Mike on as our guest to really walk us through the market side of it. But definitely excited to hear the rest of our conversation.
All right. So before we bring Mike on, I also want to introduce Ron Stowers. I've interviewed Ron before, so it's not his first time on the show, but he's not a regular on Friday. Whenever Ron and I go to events together, every time I've been at an event, he's been at an event, we do a walk and talk. We usually start between 5:30 and 6 in the morning. We want to get out before as the sun is coming up, and we just talk shop. So Ron and I were talking this morning. Ron, thanks for, last minute adding this to your schedule and joining us today, brother.
Yeah, thanks for having me. There's so many variables right now with interest rates and markets. I cannot wait to hear Mike's insights on them. It'll be great.
Yeah. And so, guys, Ron is the way I met him. He's the chief strategy officer for Homeowners Financial Group. He managed our partnership. He is also a consultant and has become co-owners of Little Nessie, an awesome consultancy that does. Well, how would you describe what you guys do now, Ron?
We're a marketing and media company helping people kind of establish and amplify their brand.
So why don't you make that one of the things that you call out as Mike is giving us a halftime update and a forecast, tell us what's happened and a forecast what's happening. Maybe one of the things you do is just call out where could that be used in media? How should loan officers and leaders leverage this content? Sound good?
Yeah, sounds great.
All right. Well, hey, Mike, thanks for always making time to come into this community and, kind of share your wisdom. Mike's one of the top speakers in the industry when large companies have sales rallies. Whenever the NBA has a large event, he's the guy. He is the chief economist for the NBA. So Mike, before you start sharing slides and takeaways, when you think of the first half of the year, there's a lot of little things that have happened, and there's some big things that have happened. What do you think are some of the big signals in the first half of the year that should be noted as we move into the second half?
Well, Dave, thanks for having me. I appreciate being here with the group. I would have appreciated a heads up that it's Black Shirt Day. Didn't get the memo, but thank you
Hey,
for that.
anytime you're on my show, it's Black Shirt Day.
Gotcha. Yeah, it was a wild first half, and I think, in any business, having sort of a clear view of what is under your control versus what's not under your control is a good sort of strategic sense, right? The tariff and trade situation, the geopolitical events, the travails around the U.S. budget deficit and debt and the tax bill, all that completely out of your control, but it certainly has impacts on your business, right? And so I think that's always the juggling act that so many lenders have to deal with, or loan officers, when you're talking to your customer and literally there are bombs going off in the world. How should they think about that when it comes to, do they go ahead and make that decision to buy their home or not, right? So I just think first half of this year is just rampant uncertainty, the levels we haven't seen in quite some time, financial market volatility. And yet, I think as you call out in your report, Dave, and I'm going to show some pictures in this is a very different housing market than was the case 6 months ago. People have to recognize that this is no longer the supply constrained market that we were also worried about in 23 and 24. There's a lot of inventory in many markets around the country right now. So that really changes the nature of the conversation. It changes the pre-qual discussion. It changes, how folks are thinking about what they can afford and whether that's going to change next week, right? I think we're going to be in a more stable environment from that buyer perspective. But I think for the rest of your customers thinking about that move-up buyer, it starts getting a little antsier because they may not be able to sell that home immediately anymore. So I think just thinking through impact of your business of we are no longer in this unbelievable seller's market that we had the past couple of years. It's much more balanced, and there are upsides and downsides. You got to consider that for your business.
Got it. My big takeaway from what you just said is control the controllables. And we had a first half of the year with just a tremendous amount of things that could create fear, things that were not what we planned, things that are not only economic things, but things like Rocket acquiring Redfin and Mr. Cooper. Ron, anything you want to call out that Mike just said, or any questions for Mike?
No, you're exactly right. For mortgage professionals, real estate agents, all you can do is control the controllables, but you do need to be educated on the things that you can't control to help your client manage your client's emotions and set reasonable expectations. Don't let their emotions get in the way of making great decisions.
Right on.
And Ron, we've had a lot of conversations at MBA events recently where it's your customer, right? And thinking about how to guide them through it. It's your team, it's your counterparties, it's everyone you come in contact with through the day. You can't turn off the news cycle, right? And even if it isn't directly impact what you're doing, it's front of mind for so many people. So it's a real challenge.
Something I want to call out, it was said from stage multiple times by some of the most elite loan officers in the country, is that it's never been more important that we be the news. Because the way that mainstream media is going to bring the news to the market, one, it's not local. Two, it's, there's a lot of clickbait and toxicity that is not balanced. So it's never been more important, if you're a mortgage advisor, if you're on this community, that you're bringing the news and you're doing it in a highly hyper localized way and an individualized way, helping your consumers within the experience know, like, hey, what do you think is going to happen to interest rates? Because, by the way, to the consumer, Bob and Shelley Smith, they don't know Mike. They're just, who knows what news channel they're watching. And so, like, what is their assumption? What do they think is going to happen? And then be the person that can help them make an informed decision. Todd, anything you want to call out or ask Mike before we get into it?
Well, I think Mike nailed it, right? It's we all know it's our opportunity to educate on the local markets. I presented to a group of about 50 real estate agents on Wednesday in Orange County. I missed you, Dave, since you're in Vegas. And it was interesting because the leader of that team said, really, there's two markets there. There's the market that meets three criteria. It's priced right. So that's the biggest key, in my opinion. Looks good and is marketed well. The average days on market there is 13 days. Everything else that is missing one of those criteria is, who knows, right? It's off to the, could be 60, 90, 6 months or a year. And so part of that is you as a loan officer being able to come alongside of your real estate agent and support the narrative that they're telling their clients. So when you've got a client of yours that wants to sell their house for more than the market, then, you can use a story like that to help them understand that they're setting themselves up for frustration versus listening to the expert guidance of their real estate agent. So I think it's more important than ever. I like that be the news, but I think it's more important than ever that we also just come alongside of our agents and really help educate on the market. And so you have to be the local market expert, because certainly if your clients selling in a community that has 17 other houses for sale, that's going to be different than if they're selling in a community that hasn't had another home on the market, for 17 weeks or 17 months, and maybe they're going to have an easy time selling their home.
So here's how I want to position the call. We're almost done with what I call the first quarter of this call. As we have Mike start sharing slides and insights, think of this as we're coaching you up so that you can be better coaches to your realtors first and foremost, because that's your, you know, your alpha partner, and to the consumers that you serve. So myself, Todd, and Ron, you know, we'll interrupt Mike from time to time. Mike, if there's a little breaking point where you want to get our feedback. And then I want to remind everybody that's live on this call right now, put your questions, put your comments in chat. Let's have, guys, you've got the chief economist of the NBA on behalf of the industry sharing, you know, how they see things today, where they've been and where they're going. So let's get smart. So Mike, take it away, brother.
Great. Thanks, David. Absolutely. Please just interrupt me at any point with any color you'd like to add. I'll be the play-by-play guy. But I want to start with really the macro picture. So I think we're back to that place where each month the most important data point is the first Friday of the month job market report. What I'm showing here in dark blue is average monthly job growth going back to 2010 or so. You see the big job losses at the onset of the pandemic, the huge rebound in 21, and then sort of the step down in job growth since then. Thus far in 2025, we're averaging about 150,000 job gains per month. May was a little slower at 139. I'm not going to be surprised if in the second half of this year, this dips below 100,000. So I talked about all the sources of uncertainty out there, whether it's geopolitical or with respect to the budget and the tax bill, a lot of uncertainty around exactly where tariffs are going to land. But we think we're going to be in a slower growth environment, still growing, probably not a recession, but slower growth. And with that, the unemployment rate, which was at 4.2 in May, we see getting up to about 4.7 by the end of this year. So not an awful job market, but a tougher one than we've seen so far. If anybody has kid, friend, niece, nephew who just graduated from college, they will tell you it is tough to land a job in this environment, right? It's not that we're seeing a lot of layoffs, but for folks that do lose a job or new entrants to the job market, the hiring rate is so low right now that it is tough to land a new job. So again, we expect the unemployment rate is going to be a bit higher. And thinking about your buyers, that's obviously a source of anxiety, right? Of, you know, are they going to be able to retain a job in a world where the unemployment rate's going a bit higher? The second macro influence is what's going on with inflation. Just got a new number this morning. Yeah, at least through May, the numbers are looking relatively positive, all heading in the right direction. We're not back to the Fed's goal of a 2% inflation rate, but we had been heading in the right direction. A lot of worry that the impact of the tariffs is at least temporarily push that up. Our forecast has inflation going a little above 3% by the end of this year, and then next year heading back down again. So again, not a huge concern. A lot's going to impact on exactly where those tariff rates end up, but you know, something worth watching. So let's go to what we're seeing in terms of current mortgage rates. And I'm showing it this way because I think there's a real sort of need to focus beyond just the headline 30-year conforming rate, which, you know, 6.7-ish today. You know, we're at about a little below 4.3 on a 10-year treasury. But what we're seeing is a wider spread between FHA and VA rates and conventional rates. And not surprisingly, when borrowers can get a better rate on an FHA loan, you're seeing more borrowers opt for FHA and VA if they're eligible and qualify. I think a lot of this is coming from some secondary market trends where Ginnie Mae securities are getting bid a little stronger than and GSE securities. And I expect that's likely to continue given some of the changes in the environment we're in right now. So that's one thing to focus on. A second is I'm showing jumbo rates here as well. We're back to a place where jumbo and conforming rates essentially right on top of one another. So that has not always been the case. But I think it's reflecting strong bank appetite again to hold on to those high income, high wealth borrowers, and that they're willing to bid a bit more aggressively for a jumbo loan. So This is just sort of give you a sense of sort of where mortgage rates have been.
Hey,
In thinking about, please.
Mike, could I jump in real quick? Could you stop sharing real quick? I just want to call out for, anyone on the call, which most of you are, active Mortgage Coach members. If you do not have our mobile app downloaded, oh, actually, I can't show it. Well, anyways, I was thinking I was going to be able to share my mobile phone, but I want to remind you guys, if you're looking at this, download the Ratewatch app. And then if you go to the little menu at the top, you could go to rates, and this will show you Optimal Blue's current active rates. Again, the largest pricing engine platform. And you can see what 30-year fixed rates are at aggregate at Optimal Blue. It'll show VA, USDA, FHA, jumbo. So make sure this is a reference tool and you have this downloaded. Also, well, I won't go into detail on it, but I just want to make sure you have that app downloaded. It's Ratewatch on the App Store. And just know you can get real time every day what those rates are. And you can share it from your phone. So it's a very useful tool. Top producers use it all the time to like, hey, this is what rates are at aggregate. And so just want to make sure y'all know about that. All right, Mike, back to you, my friend.
Cool. So yeah, so the two takeaways from this, FHA VA rates even more competitive than they typically have been. Second is that there is a strong jumbo bid out there. So just I think two things to keep in mind in this environment. Next, if you look at sort of the broader spectrum of rates and think about that macro story I was telling you, obviously really important to keep an eye on what the Fed is likely to do. Now, Chair Powell was testifying before Congress this week, both the Senate and the House, on their current monetary policy stance. And they're really facing a challenge because if our forecast is right and both unemployment and inflation are likely to rise, it's really not clear exactly what they should be doing right now. Because if they wanted to combat inflation, they'd either hold rates steady or even increase rates. If they wanted to combat the increase in unemployment, they drop rates. They obviously can't do both of those things at the same time. So what you've heard Chair Powell say and what came out of the FOMC meeting last Wednesday was they're just going to wait. They're going to wait till more information comes in. They're going to be watching those job market reports each month, going to be watching the inflation. They're going to see which problem is worse. The projections they put out last Wednesday, still we're looking for 2 rate cuts this year. That's what we have in our forecast. What was really interesting, though, is what happened after Wednesday. So Wednesday, the FOMC voted unanimously to keep rates steady and really not make much of a signal as to what they're going to do next. It took all the way to Friday for that to change, right? You had one Federal Reserve governor and then followed by the vice chair come out and say, I think we should cut in July. I couldn't tell you what changed in terms of data or the fundamentals between Wednesday and Friday, but we're in an interesting political situation right now. We have a president who's been quite vocal that he thinks the Fed should cut more aggressively. We have a Fed chair whose term ends next spring. And you now have a number of financial press stories indicating that the president may select Powell's successor well in advance of when his term ends as a way to kind of nudge things along. So markets are responding to all of this news, but a little bit uncertain exactly what to do with it. So the takeaway
Michael,
I
I have
have
a
for
question.
you, please.
How much of the Fed paralysis on rate decision is linked to their fear of not being able to control the long end of the market? Last time they reduced rates, short-term rates, long-term rates went up. Is that still a real thing?
Yeah, I mean, I think a couple of things there. One, I think they're absolutely uh, embarrassed about how inflation got away from them in 2021 and 2022, right? That is a mistake that central bankers don't want to make because we saw the impact in our market, right? Mortgage rates more than doubled as a result of inflation getting to 9%. So I think Chair Powell, a lot of others on the committee are bound and determined not to let that happen again. And this risk that tariffs would lead to a further bounce in inflation, absolutely a concern. To your question, that speaks more to the credibility of the Fed, right? So if markets view the Fed as credibly determined to keep employment stable and keep inflation at 2%, they sort of give them the benefit of the doubt. If they begin to question whether the Fed really is focused on keeping inflation stable for the long run, the long end of the curve will go up. Now, couple that with what I talked about, we're in a world where the US government's running deficits of 6 to 7% of GDP each year. Debt to GDP is at 100%, the highest we've seen since World War II. We're about to pass a bill which would add 3 to 4 trillion incremental on top of that over the next 10 years. The Treasury is going to be issuing a lot of debt. And we're in company with basically every other government around the world that's doing the same thing. So we're fighting for those dollars. So there's going to be pressure on the long end. And so what I'm showing here in our forecast is sort of a relatively benign version of that, where, yeah, the Fed's cutting, but long rates aren't moving. So we think the 10-year Treasury is basically going to be next year where it is today. And mortgage rates might come in a bit, but that's really a factor of mortgage Treasury spreads normalizing at least a touch. But to your point, I think we're going to be in a world where the yield curve keeps getting steeper. So here I'm showing the spread between the 10-year and the 2-year. So we were talking about inverted yield curves in 2023, where long rates were below short rates. That has changed. It's now up to about 50 basis points. You look over the past couple of decades, that average spread is about 85 basis points. I think we're going to get there and maybe beyond. Now, the biggest implication for a loan officer is this is going to be a world, going back to this rate chart, where ARM rates are going to start looking pretty good, right? And I'm going to jump ahead for a second here. If you look at ARM share of application volume, last couple of years we were sort of 3 to 4%. We're now between 7 and 10%, right? I think it's going to go higher because of this trend that we're seeing, where the yield curve is going to get steeper and steeper. Depositories and even the securitized ARM market is able to offer much better rates for the kinds of hybrid ARMs that we're seeing now, with initial fixed terms of 5 years, 7 years, what have you, compared to a 30-year fix. So you look at this chart on the left, there's no way we're going to get back to a 35% ARM share like we had in 2005, when I had less gray hair than I do now. But we could certainly be in the teens, right? And so, Dave, I don't know what your thoughts are, but do we have originators who are well enough versed in ARM lending to be able to make the case there, as well as the secondary market outlets?
So if you can stop sharing your screen real quick, and I'd love to workshop this. I think this is a really important topic for the street, and for us to, one, talk about with this group, and then two, if you're on this live in Zoom, I would love to know, are you presenting ARMs as an option? And I have some really strong opinions around how a mortgage professional should approach this. I'm always against selling any product. I'm always about giving people options, explaining the pros and cons, and helping consumers make the decision that suits their risk profile and their financial needs. So I'm just going to say that, like, I do not believe in selling a specific strategy, but let me know. So Kathy, thank you for jumping in. Ron, why don't you go first with your thoughts on this? Todd, you go, and then let's just workshop this for a few minutes.
Yeah, that's great. Michael, I'm in total agreement in that I think that long-term interest rates, 30-year fixed, are going to stay elevated. Higher for longer is going to be longer for the mortgage industry. And that with the spread widening between the 2 and the 10-year, that we're going to have the opportunity to get back to ARMs and intermediate ARMs, maybe even get back, I think, to 15 to 20% of the market. My question, and I'm sure everybody on the call might be curious in, is there a market, a secondary market for them? Because right now, really, credit unions dominate that space and originate a lot of those loans. And the street, the IMB, and even wholesale doesn't have the same cost structure. And we don't have a competitive product because it seems like there's not an appetite for that product on the secondary money market. What do you see developing in that end?
Yeah. Two points. You think about sort of where we come the past couple of years. Spring of 2023, we had the failure of Silicon Valley Bank and Signature Bank and First Republic, right? Sort of all in a row. Banks really got hampered by that sudden run up in rates. Both their loan portfolio and their securities portfolio, they have a ton of embedded losses there. So that was really preventing them from being more active buyers of loans in 23, 24. I think that's beginning to change. So you mentioned credit unions. I'm imagining more banks might be willing to buy originated ARMs in 25 than was true in 23 and 24. So that's one outlet. I know there's some challenges with sort of ready supply, steady access to that. The second is at our secondary conference in New York. We always get updates from the folks at Fannie and Freddie, and they certainly are attuned to this change in the market and are working on that securitized platform. It is more challenging to securitize ARMs than it is to securitize fixed rate loans. I mean, just think about, if you're 6 months into a 60-month fixed rate term, that matters a lot for the value of that loan within that security. So you got to time things just right. But I do know they're working at it, but I think it's an ongoing challenge.
Todd, I've got some thoughts I want to share on this, but before I do, anything you want to share or any questions you have on this topic?
Well, no, I mean, I think it just goes back to you as a loan officer, especially those of you who weren't around when ARMs were a big thing, is just getting familiar with that. And then I think you kind of nailed it, Dave, right? Everyone needs to be doing a total cost analysis, and it's not your job to tell people what to do. It's your job to actually be curious, right? It's one of the cornerstones of effective communication, and exactly what to say is curiosity is the fuel for great conversations. And so really it's just a matter of showing it to your client, because especially if your client's doing research now, right? I saw in your report, Dave, that said 43% I think of people are using ChatGPT to research loans. And so, chat's probably going to say, look at ARMs. And so you have to actually have that as part of the conversation. Your client's expecting it, and then give them the pros and cons, and then let them make the choice by using that discovery of asking questions and then following up that with the next question and then following up with the next question. In the end, they're going to come up with their own decision that they're going to be super happy with. And that's the bottom line. That's really your job.
All right. So well, before I go, I want to ask a question, because I, in my conversation with Bill Dallas recently and a few other leaders, had heard that the street might be getting some interest-only ARM options. Mike, do you have any idea whether or not IMBs or any interest-only ARM options are possibly in play over the next 12 months?
So we track credit metrics along a number of fronts. We have our credit availability index, and if you look at what's out there, I would still call it sort of incremental in terms of additional IO products. And bigger picture, the non-QM piece of the pie certainly is growing, but still relatively small. So that's where I'd put it. That it is, it's outside of the mainstream at this point, but certainly something that would help affordability in a lot of markets. But I guess I'm thinking just the most conservative forms of ARMs are where we're going to see most of the volume growth here.
Yeah, well, and I asked that question because if we do see interest-only 5-year, 7-year ARMs, that would be a pretty powerful affordability strategy, and it would be very needle moving. If anybody has an opinion on that, share in comments. I'll continue to keep my eyes open for that. But I just can't emphasize enough, everyone on this call, whether you believe in ARMs or don't believe in ARMs, whether you think an ARM is the right strategy or not, if you want to win in the biggest way possible, you're giving family options. You understand the options that your company provides, and I talk about this all the time. Authorship is ownership. When you work with a customer and you say, hey, here's some options. Here's a 30-year fix, very conservative. Here's a 5 or 7-year ARM. Here's a 2-1 buy down. Remember, date the rate, marry the house. I don't necessarily like that term, but what do you, and again, get their assumption. What do you think rates are going to do? What do you think appreciation rates going to do? And it's never been more important that you know those personal assumptions, and then you're helping tell a story to a consumer so they can make an informed choice. And here's what happens. When you go through that process, you win trust. And when you win trust at scale, you have high conversion rates, you get lots of referrals. And here's what else happens. You rocket proof your career, because big centralized lending platforms aren't going to focus hyper local, hyper personal, like I just explained, and you're going to be a real advisor. So I think it's just an important topic. Anybody else have a comment on that or another question on this before we move on?
No, I mean, I think you're spot on, Dave. I mean, that's really the bottom line is you've got to as a loan officer be the captain of your own wealth team, right? You got to be the captain of your knowledge team and make sure you understand it. And I still find that oftentimes when I talk to loan officers who are opinionated on it, we're seeing some comments in here about pricing, and it's difficult sometimes to compete with some of the, the credit unions and the other banks that are loaning their money. It doesn't really matter. The bottom line is you still need to be educated on it so that you can do a great job helping your consumer. Because you're right, Dave, that's how you're going to get that next loan.
Yeah, and that's how you bring unique local value to both realtors and to consumers. So cool. Well, let's keep going, Mike. I know you got more slides and more insights. And by the way, guys, Mike did share these slides. They will be available in the file section of our Facebook group, the MortgageCoach Productivity Facebook group. And if you're watching this on YouTube, there'll be a link down below brought to you by housing.link. And we'll have all the links that we mentioned. I mentioned the housing report. It's on LinkedIn. Please, look at that halftime report. I highly recommend you read it. I highly recommend you share it with anyone that would get value. That link will be in there, and as well as a link to these slides. All right.
So going back to this one, you might have noticed that while our 10-year Treasury forecast is for the 10-year to be essentially flat over the next couple of years, that said, not the same. There's going to be a wide trading range around that. We just don't expect there's going to be a trend up or down. But you might have noticed that our mortgage rate forecast has mortgage rates drifting down. A lot of that is because we think the spread between the mortgage and the Treasury rate's likely to narrow a bit. This is from a chart of the week we did a couple of months ago. And what it's just really highlighting is a good portion of that spread is reflecting just the volatility in rates. So this burst of volatility we had around the Liberation Day tariff proposals led to a jump in measured rate volatility. For if you're an investor, that increases the prepayment risk of owning a mortgage-backed security. They essentially charge more to bear that risk, and it's reflected directly in higher spreads between mortgage and Treasury yields. That's come down since then. I am hopeful, certainly not certain, but hopeful that as some of these trade deals get ironed out, as we sort of get more certainty about where the Fed might be headed over the next several quarters, the spread will come in further. So our mortgage rate forecast, maybe we get to 6.5 by the end of the year. But I think to Ron's point, that's not a whole lot different than what we're seeing today, but at least a little bit lower. That said, I think another thing that everyone should be aware of is it's not going to take much in terms of a drop in rates to get a real burst in activity. And we've seen two examples of that in the past 9 months. So September of 2024 and then sort of February, March timeframe of this year. This is our refi application index, and you just see how it just jumped off the page. And the right side of the page showing that, while the refi business you're doing from day to day is really dominated by cash out at this point, lower loan balance for the most part. When you get these rate and term moments of opportunity, that average loan size jumps because every borrower from FHA to jumbo is going to want to take advantage of that opportunity. And the number that really sticks in my head is if you look at 2023 and 2024 originations, there's about $400 billion worth of loans that are in and out of the money for a rate term refinance with a fairly small move in rates, right? And that's what we saw in September 2024. if we were to get some shock of, yet you can sort of guess where it might be coming from, that could bring the 10-year down close to 4, the 30-year mortgage rate down below 6.5, we will get another burst in activity. I have to tell you, it's maddening for me as a forecaster because we think there's going to be a little less than 700 billion in refinance in 2025, but there's 400 billion that could be in and out of the money. That's quite a swing. And so if it's tough to be right as a forecaster. It's even tougher when we're in this kind of an environment. So again, I think there is a refi opportunity. I know, Dave, if you want to jump in on that before I start talking about purchase, but it's going to be in and out, on and off.
Yeah, I do. Let's stop sharing. Let's workshop this too. I got a lot of thoughts on this, although it won't take long to share them. But Ron, anything you want to share, and then Todd, and then I'll go last.
Yeah, the thing that just keeps, is readily apparent is the modern loan officer has to stay informed about the market and opportunities, but they also have to maintain influence with their customers, which you can only do by staying in contact with them. As Michael said, the opportunities to refinance are fleeting, and as I remember Brian Hill mentioned these refi boomlets, we're going to have little boomlets throughout the year, but they're only going to be realized for people that are in position that have influence with their customers to be able to act quickly. And it's just a really good reminder.
Yeah, Todd.
I love it. Refi boomlet. It made, yeah, Bill Hart called February a microburst of refinances. And Mike kind of nailed it. He said we have moments of opportunity. And so, yeah, Ron, I mean, I think you're right. You have to maintain that influence. And so my question for you loan officers is have you actually talked to your database this year of the 400 billion that Mike's talking about that are refinanceable? You've done loans in the end of 2022, 2023, 2024 that absolutely are refinanceable. I'm seeing loan officers taking advantage of that, but you've got to go back to where Dave opened the call, right? You got to be rocket proof because the bottom line is, I promise you, the servicer's keeping in touch with them, even when you're not. And what you really want is that when the servicer pings them, even though you might not think it's the right time, the client is questioning whether or not you're actually taking care of them like you promised you would. And so that's why it's just more important now than ever. Super easy, right? Record a quick video with a quick market update of what you're watching on their behalf, and then text it out or email it out to them. I mean, it's really easy to do with technology. You just have to choose to do it. And so that'll be my homework for the day, Dave, when we wrap up.
Yeah. Yeah. So just to emphasize a few things and then just give some tactical clarity is, first of all, best practice when you are doing a purchase, you are always talking about the future refi. Like you're scheduling the refi and agreeing on a strike rate with a purchase. And even to the point where you put that in your MortgageCoach total cost analysis. So we have alignment when rates get to here, you're ready to go. And they understand the cost of that. Now let's say a year's gone by. Let's say you didn't do that in the purchase to begin with. You need to be getting alignment with clients that are close to the money. Now you need to be calling out, doing a mortgage review, letting them know what's happening in the market. Remember, the relationship and the quality of the relationship and the connection you have with the consumer is your best way to retain that customer and get referrals. And if you're not doing that, servicers are, and they're gonna crush you. They're gonna get there quickly, and you're gonna lose a fortune in loans. So get out there, have that strike rate price, use a total cost analysis to show it, and then make sure that when rates do come down and they get in the strike rate price, you can anticipate where that consumer is gonna go. They're gonna go, oh, that's great, but I want to wait for it to be even lower. Like all the time when rates start to drop, everybody just starts like, well, what about, should we wait now? And so, I'm not in a place where I can share my screen right now, but if you come to either our Wednesday training or our Thursday training, our head coach Spencer can show you how option A is what you have. Option B is lower your rate, look how much money you can save. Option C, the third strategy is, what if you took the savings and prepaid your mortgage? How much faster would you pay off your mortgage? How much interest could you save? That's value to the consumer. That helps them. Like, do you want to lower your payment or do you want to lower your term? And then be ready for that fourth option where you say, oh, you want to wait till rates get 0.5% lower? Put that in MortgageCoach and then close the loan at what it's at. And when rates get to the next point, we'll talk. But where everybody lost a fortune last September is that, I think, I don't know if you have any data on this, Michael, but what percentage of the applications that were taken actually got locked in and closed? Like, at least from what I hear from the street, a lot more loans, got locked in and never closed because it was such a short spike. Any data you have on that?
Yeah, we track pull-through rates. It's always the case that the pull-through rates on refis are lower, sort of, getting down towards the low 60s, particularly in moments like that, where on purchase, they're closer to 70. Yeah, I don't have something specifically for that moment, but I would totally believe that, yeah, the folks that didn't lock in at the right point just sort of threw in the towel.
Yeah, well, Todd just said in chat he'll give some scripting in his wrap up. So, Mike, let's get back to you and make sure we get through all your updates.
Yeah, yeah. So again, moments of opportunity on the refi side, but most of the business you're going to do is going to be purchase. But I do think, as I sort of hinted in my opening remarks, you got to be aware that this world is a little different than was the case even 6 months ago. So if you look on the left, home sales, month to month, we're seeing some noise, but overall, we're a little above where we were last year if you take new plus existing. But it's this picture on the right that is really the big change, where what we had been calling out the run up in new home supply. We're now up to about 10 months of supply at the current sales pace, more than 500,000 new homes. An increasing number of those are move-in ready. So it's not just ground. It's these are homes with windows and garage doors and everything. On the existing side, you're seeing existing inventory up, about 30% compared to last year, about 1.5 million homes. So we are getting really quite close to what folks would think is a balanced market, and that impacts the way we look at the world. This is our forecast for where we think home prices are going. So full year 2024, home prices were up a little more than 4%. Our forecast for this year is a little less than 1.5%, and we think home prices are going to be pretty flat the next 2 years, in 26 and 27. So that is a world of difference from the double-digit home prices increases we were seeing in 20 and 21, or even the more typical, 4 or 5% growth that we've seen for long periods of time. And obviously huge differences in different parts of the country. So there are markets now where we're seeing year-over-year declines in prices, parts of Florida, parts of Texas, along the Gulf Coast. You're seeing definitely a slowing market in California, other parts of the West. And then there's the other side of the coin. If you look in the Northeast, where it's typically been much more difficult to build, you're still seeing 4 or 5% home price growth. Parts in the Midwest, you're seeing sort of low single digits. So it's kind of curious, right? Because that's the opposite of what we're seeing in terms of the longer term trends. Longer term, you're seeing faster population growth in the Southeast and the Southwest, and sort of net migration out of the more expensive markets, like in the Northeast. But so that's the world we're living in. Again, just thinking about the pace of activity in purchase right now, this is back to our weekly application survey. Look at that black line, which is 2025 volume, compared to the green. So we're now running 15 to 20% ahead on a unit count basis of where we were in 2024, peaking above that 2023 line. We got the mixed set of factors here. You have we think we're going to see some softening in the job market over the second half of the year. But if the mortgage treasury spread comes in, you have a few more folks going FHA, VA, or ARM. That lowers their cost of financing. And most importantly is this picture, that whereas in 23 and 24, you could pre-qualify a borrower, but they couldn't either win the bid on the home or even find a home available for sale. That's not the problem right now. There's going to be properties available there for folks that want to move. As I said in my opening, I think that the bigger challenge now is going to be that move-up buyer who didn't have to worry about would they be able to quickly sell their current home. now it's going to be a bit more of a concern than had been the case. So,
Hey, real quick there. You don't need to stop sharing, but I just wanted to call out being expert at being able to show people how to buy before they sell. And we've got lots of examples of where a mortgage coach would, column A would be, hey, here is your bridge loan, which it's at 10%. It's ugly, but here's what it looks like to buy before you sell. And then once you've sold, this is what it looks like normalized, column 2. And then column 3, and when rates come down, what do you think they'll come to? Oh, this is what refi looks like. To be able to visualize and make it clear what is buying before you're selling looks like. It's never been more important to be able to have that conversation. Or for a move-up buyer that's at a 2, 3, 4% mortgage that's moving into a 6 or whatever mortgage, to be able to show them that, oh, look, you're buying a more expensive home. What do you think appreciation rate's going to do? Oh, what does that mean over 3 years? What does that mean over 5 years? Based on what the market is, it's never been more important that you can navigate that conversation with clarity for consumers. Again, remember, Wednesday, Thursday, Coach Spence will tune you up if you don't know how to do that.
yeah, really good points. So this is our origination volume forecast for those that track it. Our call on 2025 just a touch lower than what we've been saying previously. Still think it's going to be a above $2 trillion market. But two things I'd call out to you here. One, the blue line is our purchase origination forecast. So just anticipating sort of slow, steady growth the next couple of years. That's all coming from additional home sales as now we have this additional inventory. Red is refi. Again, sort of the steady cash out refi business that's available. Still a lot of debt consolidation motive out there to do cash out for smaller balance borrowers and those moments of rate and term opportunity. A difference in this forecast is we now are looking at a little bit less growth in 26 and 27. So now topping out at about 2.3 trillion, just reflecting sort of the weaker macroeconomic environment that we're seeing as a result of all these shocks. So Dave, that's what I had to share with the group, but definitely let's keep the conversation
Yeah.
going about how folks are thinking about this market.
Yeah, so let's I wasn't able to share my screen, but now I can. I shared a link to this in chat. I would push everybody to go and look at this. This is what I was telling you, where show them what a current loan looks like, what the refi looks like, what the monthly savings is. What if you took that monthly savings and you prepaid your mortgage? Look at this. Home's paid off 23 years, saving 240,000. And then be ready to future cast the next refi. Also want to remind people next week, the AI feature is going live to everyone. So the consumer can now, can I buy down my rate? Quick answer. If I'm going to live in the home for 5 years, which option is best? They can ask questions of the AI. What are the closing costs between these options? Guys, this is a revolution in the mortgage industry where you're able to give consumer options, you're able to help them make informed decisions, and now the consumer can interact with your options with AI. This is in beta. Jeremy's one of our alpha testers, and this will be released to most of our community next Wednesday. If you work for a company that has an enterprise partnership with us, Wednesday, this will be released into your Mortgage Coach. And for everyone who's an individual user of Mortgage Coach, it'll be middle of July that we'll be releasing this feature. But click on the link, check it out. So let's open it up, guys. We got 10 minutes left. Ron, any comments, questions, and then, let's go around the circle here.
I have 2 questions for Michael. Michael, where there's proposed changes to the enhanced supplementary leverage ratio. I'm curious what impact you think those might have on mortgage interest rates. And then additionally, the Fed is reviewing the additional Basel III rules. What changes do you see happening, and what impact will you think will have on housing and the mortgage interest rates?
Yeah, great question. So, both of those regulations, I think, were artificially constraining banks from being able to provide services to the market and to their customers. So, the supplementary leverage ratio, the impact of that we really saw in the middle of the pandemic, where it really greatly reduced the amount of liquidity in both the Treasury and MBS markets, right? That Treasury, MBS, essentially zero credit risk securities, and you had banks really unable to add to their balance sheet because of that requirement. So that the kinds of changes they're proposing to make, I think, are really fantastic. It's not like you're going to see lower mortgage rates as a result from day to day, but you're going to see the ability of the market to maintain liquidity even in a crisis that was really impaired by that one. The Basel III capital requirements, we have seen now for 15 years banks playing a smaller and smaller role in the mortgage market. And, some folks have gained from that, but I think the loss of that liquidity is ultimately harmful to the consumer. We want a vibrant, dynamic market where lots of folks are competing for a customer's business. And particularly when it comes to things like ARMs and jumbos, you want banks to be eager to buy those loans and hold on to them. So I think if they get Basel III right, that'll help bank appetite for mortgages.
So
So possible.
that would bode well for ARMs, is what you're saying.
And jumbo, yep.
Got it. So we need that.
Yep.
Got it. Remember,
Exactly.
audience, if you have questions, put those in chat. Ron, anything else?
I got one other question. It seems as though builders are scaling back on their building appetite right now. Production has dropped, probably will be for a couple of years. Do you foresee then that we're going to have an increased shortage of houses here in the next few years, and then we might have accelerated appreciation because of it once we get past this kind of malaise that we're in right now?
Oh, it's a great question. And we're seeing it both on the multifamily side and the single family side, that we had this burst of apartment building. Now that's slowed down. Rent growth is pretty much flat at this point. And then you saw our forecast for essentially flat home price growth. And you're absolutely right. Builders are tapping the brakes. I think, I mentioned all those sources of macro uncertainty. Another one is where immigration policy goes in this country. We're getting to the point in terms of sort of population dynamics where, you've heard about, we're fertility rates are low. We're not forming as many households as we used to. If immigration, if that spigot's turned off too, we're not going to see the growth in housing demand that a lot of folks have built into their models. So I'm less worried about a sudden spike in home prices or rents. And I think it's pretty sensible for builders and developers to be tapping the brakes a bit now.
All right.
Thank you.
So first of all, guys, I can't recommend enough that you follow Ron Stowers on social media, primarily LinkedIn. He posts, I think you post every day on LinkedIn. Is that right, Ron?
Absolutely. Yeah, at least 1 or 2 times a day.
Yeah, 1 or 2 times a day. Is it Friday you do your book reviews?
Sunday on book reviews.
Sunday on book reviews. But guys, he is just an encyclopedia of what's happening in the industry. Pure gold, pure value. So right now, we'll put a link down below, make it easy for you to go follow Ron, watch his most recent content. But you want to be smarter around what's happening in mortgage, follow this man. Same goes for Mike. Mike, we just couldn't be more grateful for you. Todd, questions, comments, anything you want to say as we wrap this up?
Well, I mean, man, Ron just showed us how smart he is. I mean, those questions were like way up here over most of our heads. So I love that. And I love the insight. And it just reminds me, I've got to follow you guys both all on LinkedIn a little bit more. I really just going back to this whole idea of the script and the video. Number one is you hopefully have your database at least segmented somewhat. And all in your cell phone, right? One of the things that I find is oftentimes loan officers don't save all their clients' names, first and last name in their cell phone. So it makes it really easy to reach out. Then you can put notes in there, like, low rate or whatever it is you need to put in there. But you really want to think about how to segment it. and you want to have the video, even though you're going to send it out, if you only have 25 or 50 old clients because you're newer in the business, then you can actually send individual videos. But most of you who have bigger databases, but you're still going to need to send out, at least 2 different videos. One video that's to the people who have super low rates and really aren't a refinance candidate. Because if you send them out a video saying it's time for you to refi, they're going to think, well, gosh, you know what? Todd's not really paying attention or doesn't really remember me. And then those who may have an opportunity to do it. And I did throw a link in here for the online 2 days of critical conversations for loan officers that Deborah and I are rolling out. We based it off of Phil M. Jones recently did a version of it for real estate agents. And so we're doing a loan officer version that he's encouraged us to do. It's going to be 5 hours, 2 different days, but it's the same content both days. So that way, if people can't attend one day, you're not missing out. However, you can attend both days if you want. And it's $249. So it's the closest way you're going to get to our $2,000 certification. That's, 2 full days, for $249 online. If you're a branch manager, do it in your office and sit there with your LOs. It's just a good opportunity. And we've still got space left for a small group of folks to be on there. But I would start it off again. I'm always going to insert some of my Phil Jones stuff. And I would be like, hey, you know what? I bet you're a bit like me and just really confused about what's going on right now in the economy. And, I just listened to Mike Fratantoni, the chief economist from the Mortgage Bankers Association, and I would just love to spend just a few minutes with you to catch up and let you know what I learned. When would be a good time? Again, that's a Phil Jones thing because you're assuming there's a good time for us just to have a brief call to catch up. Like that's just super short, right? You can insert in the middle if you want, your 1, 2, or 3 takeaways that you heard here from Mike or something that you're thinking. But again, if you make it too long, it's less likely people will listen to it. And then you could also insert in there differently for the folks who are 3% interest rates, aren't going to refinance, and just say something like, hey, I know I got you that amazing interest rate, back during COVID, but I would still love the opportunity to catch up with you because I think it's a great time. And then jump right in there, right? When would be a good time for a brief conversation for us to catch up? Because you want to ask them that question so that you can assume there's a question. And then I would be like on it. I would send a text back 2 days later that says, hey, not sure if you had time to watch my video. When would be a good time for us to have a quick call to catch up? ? That's really it. Because if you don't say, hey, do you have time for a call? That's a yes or no. It's you're asking them an open-ended question so that they'll respond. They may just say, hey, too busy right now. But it's basically just an opportunity for you to re-engage with your database, especially if you haven't talked to them in a while.
All right, guys. One thought on that is just remember for all you that have the Trust Engine or Mortgage Coach app, we're telling you who to call, like exactly who to call in this app.
Boom.
When you click on it, it's got scripts, exactly what to say. You can edit those. So for clients like Homeowners Financial Group, Ron's company that have the full Mortgage Coach Next Gen platform, update those scripts. If you're in leadership or management, make sure that your loan officers are trained on this. Mike, couldn't be more grateful for you. Is there any closing thought you have before we do a final wrap up?
Well, thanks for having me. I mean, I dropped in the chat a link to our Chart of the Week subscription, so it's free. If you're interested in the kind of data I presented here today, just sign up and you can get that every Friday morning. So again, appreciate the time. I really, really like getting sort of your sense of sort of the on-the-ground impact of some of these trends. And so thanks for having me. Always happy to come back.
So guys, you should absolutely be subscribing to that link. I mean, the MBA is an incredible organization. The lobbying that they do on behalf of our industry, be active. Mike, remind people how they can, donate money, help support the MBA real quick. Just, I don't think there's enough loan officers that support the MBA the way it should be supported. Could you just share real quickly on how
Yeah.
can a mortgage professional support?
Yeah, absolutely. And the best way is free. We have something called the Mortgage Action Alliance, where when there's an issue that you'll benefit from the industry reaching out to your congressman and senator, and I'll put another link in here in the chat. We have it set up so you don't have to do anything. You click a link and the letters are generated to go to your congressman and senator, right? And you don't have to do it. You can revise the letter if you want, but those are the kind of things where if we show up in numbers, we really can move the dial in terms of industry advocacy. So absolutely, it's free. Totally recommend you sign up for that as well.
Well, I'm pushing you. Go sign up. If you are a mortgage coach leader, like, be a leader in your local community, be a leader with your customers, and be a leader to help support the industry. So click on that link right now. Mike, couldn't be more grateful for you. Guys, we are at the top of the hour. If you do not subscribe to this YouTube channel, subscribe so that you get updates. And if you are not following savageinsights.com, I am, whatever I think is the most valuable content is always number one. And then there's about 6 links. Make sure you're part of the Savage Insiders Mobile Club. Guys, this is a wrap. Ron, thank you for jumping in last minute. Mike, always
Thanks for having
grateful.
me.
Todd, you're the man. This is a wrap, everybody. Take care.
Good
Thanks,
seeing you all.
everyone.